Welcome to Human Risk, a podcast dedicated to the understanding of human behaviour as a risk. Here's your host, Christian Hunt.
Hello and welcome back to the Human Risk Podcast, the series where I speak to people that can help us to better understand human decision making and what we can do to mitigate the risks it poses. My guest this time, Jim Oates, is someone that I know really well. That's because he used to be my boss when I worked at UBS. Jim played a key role in helping shape my thinking on human risk because he encouraged my curiosity in exploring behavioural science as a means of improving the level and quality of compliance. Not only did he support it, but he made it possible for me to move to a role that allowed me to develop it, which led to what I do now. But Jim isn't just on the show so I can say thank you to him. He's also on because he's got some great insights into human risk. Before he moved into compliance and operational risk, Jim's career was spent as an auditor in financial services. Now, audit is often viewed negatively. Listeners who have worked in companies that are large enough to warrant their own internal audit function will probably have their own tales of joyless encounter with auditors focused on theoretically perfect but practically flawed solutions. However, that doesn't mean audit's a bad idea. If there's one lesson from human risk, it's that people make mistakes, even, perhaps particularly, when they're trying to do the right thing. So we need a function that can review the outputs of human decision making and avoid the organisation being blindsided by really bad outcomes. What Jim refers to as a mantra of no surprises, helping to ensure that the board of directors isn't surprised by significant losses or damage to the firm's reputation by an unexpected failure of controls. We probably shouldn't, pun intended, be surprised that it's a former financial services auditor that understands the need for no surprises. After all, that industry has had more than its fair share of human risk. So while he was building a function that could deliver on the no surprises mantra, Jim saw a lot of, surprises. In fact, the finance industry has seen so many incidents that it frequently borrows vocabulary from industries with physical processes to describe the work involved investigating things that have gone wrong. So in our discussion, you'll hear terms like post-mortem and deep dive. Jim has seen them all, which means he's got some fascinating insights into human risk. In particular, the fact you can't entirely eliminate it. And so rather than looking to do that, you need to understand what risks you're running, which ones you can mitigate, and which ones you can't. To help listeners who aren't familiar with financial services, on a couple of occasions I pause our discussion to provide a brief background explanation on the issue we're talking about. I've included links where you can read more about those points in the show notes. So please enjoy my conversation with Jim Oates on No Surprises. Jim, welcome to the Human Risk Podcast.
Thank you, Christian. It's great to be here.
It's an absolute pleasure to have you. And look, I know you really well, but many of my listeners won't. So can we start off by you just telling us a little bit about yourself?
Sure. I am what you would want to describe as a career internal auditor, starting an internship when I was still going to school in an internal audit department. I never thought I would do that for my lifetime, but I did actually for a long, long time, ultimately becoming the head of internal audit for UBS. And through that and through the experiences of the financial crisis, had the privilege of leading the compliance and operational risk function. And then midsummer last year, decided to do a shift change where I'm now pursuing being a professional director. So I've learned over the years and sitting in many, many hours of board meetings and boardrooms, I've seen some great directors, non-exec directors, seen some that weren't so good. I've seen some senior leaders who've been fantastic and some who were not quite so good. But I did see the value of a board member in being able to influence success at a corporation, leveraging their skills and experience. And that's what I hope to do either as a professional corporate director or as an advisory roles with businesses who might benefit from my experiences and the way I look at things.
You've seen a lot of things, and particularly because the industry that you've been in, financial services, has had, I think it's fair to say, more than its fair share of incidents. And I'm intrigued by your reflections on the things that you've seen as you've observed a whole host of different dynamics.
Yeah, there's certainly been a wild ride. I think when I joined UBS in 2002, I was the auditor responsible for the mortgage-backed, asset-backed, and CDO businesses, and spent pretty much 2002 to 2007 focused on the unbelievable growth in that market. And, this was at a time when balance sheets were becoming infinite and risk capacity was becoming infinite in the big banks. And then we all saw what happened in 2007, 2008, 2009, where, basically at UBS, we lost $50 billion, and many other banks did as well, on those assets. And that was in my backyard. And that became the beginning part for what became almost 10 years of postmortems, investigations, remediations, regulatory interactions to understand, what the heck is the key drivers of these issues? What are the real root causes, and what are the things that people need to do to make sure stuff like this doesn't happen again? And it was unbelievable experience. Learned a tremendous amount. We could probably go through different chapters of that because there's different learnings from each, even for me personally, about how to be an effective leader and how to basically win the trust and confidence of your stakeholders through these kinds of crises. But certainly, what I'm very proud of is that the financial industry at large, and in my view, led by UBS, has taken some key disciplines away that I think all industries could benefit. And that's something that I think cross industry fertilization of ideas and sharing of best practices is not done enough. In my view.
When you look at all the things that have happened in financial services, you alluded to a few of them, there's a whole range of things, any one of which could be a Hollywood movie, and in fact has been in some cases. Sure. And so as we look at those things, I mean, you have seen a whole range. What things particularly stick in your mind as being moments where you really had some key learning points or stuff that surprised you?
So first of all, when we do have the movie, Tom Cruise is going to play me, I hope. Don't laugh too much about that. But yes, Tom Cruise will hopefully play me if he's still around. So for me, like if we start with the subprime crisis, is probably the one that's the most rich because the whole world learned lessons from that. And if I tell the story from an internal audit point of view, that and I think a lot of your listeners know about internal audit and third line of defense. So I'm an avid follower of everything you're doing and supporter, and think it's been great. That in the lead up to the subprime crisis, our department, which I was proud to be a part of, was seen as meeting every international standard and being an effective internal audit department. And then within a moment of months, it turns around that we're losing tons of money, and UBS had a concurrent issue with the fiscal compliance issues and the tax evasion criticisms by the U.S. government. And the regulators in particular and other stakeholders began to question, how could a company that's having these kinds of issues have an effective internal audit department? And that's a good question, And so here we are, having met the standards for all these periods of time, and yet these things are happening. So after a number of months of reflection and thinking about it and owning that myself, how are these things happening on my watch? And saying, where did this all go wrong? I mean, we've had a series of exams of the audit department that were imposed on us, and we realized, these things aren't going away. And we really need to get an answer to this question. Why is it that these things are happening? We began to realize the book was wrong. The book was focused on the wrong things. It was very prescriptive about the process an auditor should go through or an audit department should go through, and was a little light about whether it was executing those processes with an effect that was the right outcome. And so one of the things that an external, it was KPMG, in fact, who led the external examinations of audit of UBS at that time, we partnered with them, and one of their simple recommendations was you should have a success criteria for your department. And the guy that I worked for at the time, Ian Overton, and a few others, came up with what I think was the most profound moment in the internal audit industry across any segment, was what we call the no surprise criteria. The board of directors should not be surprised by a significant loss or damage to the firm's reputation due to an unexpected control failure. And we wanted the board to say, if that happened, that us as internal auditors failed. And I remember hearing the stories about telling the other financial service industry internal audit departments, that's what we were doing. Are you crazy? You can't be held accountable for making, no surprise happening. Well, so what are we doing here then? That's what we're here for. And the revelation to me was internal audit departments were passive participants in the firm's success by large. And you kind of say, well, hang on a second. So if something bad happens in the company, the first question is, did you look at it as an auditor? No, we didn't look at it. Well, why didn't you look at it? You should have looked at it. Well, okay. Well, we looked at it, but we didn't find it. Well, how'd you not find it? We looked at it, we found it, but they didn't fix it. Well, why didn't they fix it? So you're criticized the whole way. The best way to be successful is make sure the bad things don't happen. So the key learnings that we had was we were, thinking about, are we looking in the right areas? Where is it most likely that the bad things could happen? And my key lesson from everything that happened in the financial industry, size kills.
Hi, it's Christian here. I'm just going to briefly interrupt Jim's story to give a quick explanation for listeners that aren't familiar with something called LIBOR, which he's about to talk about. LIBOR is short for London Interbank Offered Rate, and when it existed, it's since been scrapped. It was a benchmark rate that was used to price financial instruments worth around $450 trillion. That's 450 with 12 zeros after it. LIBOR was compiled from an average of rates which banks quoted as an indication of how much they would charge to lend to each other, which meant that it relied on the people who were submitting it to be honest. In quite a few cases, it turned out that they weren't being honest and were conspiring to submit rates that were artificially high or artificially low. UBS was one of the banks involved. It turned out that what sounded like a low-risk activity of submitting a number as part of a panel came with a huge amount of risk.
Size kills. So if you get big in anything, even LIBOR, the LIBOR manipulation, internal audit departments, compliance departments beforehand thought this is a low-risk issue because you get a number of different banks put them together, you throw out the highest, the lowest, you take the average of the rest, how could that be manipulated? Low probability. Okay. But if you could, LIBOR was the number one benchmark affecting most financial instruments in the world. Size kills. So it's not the size in the way we traditionally think, like loading up your balance sheet with mortgages or asset backs, but it was size in a different way. So where is there, a big implication? And even if it's not likely to happen, it's worth kicking the tires. Then when you go review an area, the next thing that we learned is we were very focused on symptoms. And when I say we in this context, I don't mean only our internal audit department, I mean the internal audit industry at large. So trying to get to a true root cause was something that mindset-wise is really, really hard. So I'll give you my favorite example. If you were an auditor 20 years ago and you're looking at system access, which is of course very important even today, you'd say 3 out of 10 people had inappropriate access. That might be the finding. And then someone who's focused on root causes might say, well, how was that like that? Well, this new issue is, there's no one reviewing the access of that system. Well, how would that let happen? Well, because we didn't make sure that we had an inventory of all the systems and that there were reviewers assigned. Well, how would that let happen? And you keep going, and eventually you get to, the CEO isn't sufficiently control conscious. Or you get even deeper to a further root cause. Well, how does that let happen? Well, the chairman didn't think about control consciousness when they were looking for the new CEO. And no matter what it is, if you start doing that really kind of profound, you do get to culture, leadership behavior, tone from the top, true risk awareness, true effectiveness. And that learning for me about ultimate root causes also with my career decision last year positioned me back to saying, where I would like to focus my time is at the top, in influencing senior leaders, in influencing board members about how they can be, how truly important their role is to make sure the whole goes well. So we're looking in the right areas. We're getting really good at root causes. And the last thing was, okay, you found an issue. And this is where the most profound change probably was. And the thing that I'm most proud of is changing the finish line or the goal line of an auditor from raising the issue and issuing the audit report, where mentally 90% of the auditors in the world felt like my job's done, and say, actually, no, your job is done when the thing is fixed well. That's when your job is done. And the moment that really matters is not after the report was issued. It's the moment you first discuss that issue with management. And, that auditor is so happy, they found something. They're excited, in the worst case, I got him, or yes, this is now the most important thing in the world's got to be fixed. And the management on the other side saying, I don't see it, I don't agree with it, you're a crazy person, This is ridiculous. The cost benefit of this is ridiculous. And the more that conversation is going on, you can already see that that person's not going to fix it well. You can already tell. As opposed to being able to communicate to that person in a way where you transfer the excitement and ownership of having identified it over the table at that very moment to the manager who's responsible for fixing it. If they said, holy, what a difference it would be. Oh my God, Jim, thanks for bringing this to my attention. I can't believe this. Hold on. Let me pick up the phone. Hey, Joe, you know what I just found out? We got this problem. Hey, can you report back to me tonight with a plan on how you're going to fix it? That's where an auditor is truly effective. And that's the thing that matters most. And so we embarked. Now, you might know that the internal auditors, and I don't want to paint all of them with that much, but usually wasn't comprised with people who were really highly effective in influencing and marketing and sales, or you almost think of that. That wasn't the core chromosome of most of the internal auditors, because it wasn't the most important thing. So we had to embark on a campaign to reposition that and give people training on and awareness on how you influence outcomes. And we had this branding campaign, which was the corporate executive board at the time kind of supported as a leading best practice is how do we become truly effective agents of change? How do we influence outcomes? So we had an enormous amount of time and energy spent on trying to raise that capability in our each order as almost a core competency. And I remember that we had to do a number of things in response to that sort of subprime, not only those kind of how the audit department operates, but we also had to take on responsibilities that weren't ever done by internal audit departments before, some of which I know resonate in your heart a lot, Christian, but one of them was before the financial crisis, internal auditors never really looked at strategy or risk appetite. And it was funny not funny, but UBS always, we were in the moving and not the storage business. That was the phrase we were for the mortgage-related product.
Christian again. I just want to explain quickly what something called a CDO is. Jim is about to talk about them, and if you're not in financial services, you might get confused. So here's a quick explainer. CDO is short for collateralized debt obligation, basically a bundle of income-generating assets, which from the bank's perspective are things like mortgages or car loans. These are then bundled together and sold on to investors who are looking for income streams. That allows the bank to transfer ownership of the debt to those investors, meaning it can lend its money elsewhere. It's a model that works really well until something goes wrong. As Jim is about to describe, what happened was that UBS couldn't sell all of the debt, and so ended up holding it at a time when the value of the debt turned out to be much lower than expected. What it couldn't sell were AAA rated CDOs, the least risky ones. Only, as he explains, if AAA isn't AAA but starts to look more like a B-rated CDO, then what you're sitting on is worth far less than you thought.
But we amassed tons of this stuff. And, the world had an insatiable demand for lower rated CDOs because they were more high yielding, double Bs. And so we were selling those like hotcakes to clients because that's what they wanted. And they didn't want the AAA pieces. So in order to fill client demand, it sold the lower rated pieces and we kept the higher rated pieces. So we had a lot of AAA stuff. What could go wrong with that? It's AAA. And, we learned AAA becomes AA becomes single A. And if you're not long of anything, then it's risky. So what if the strategy was to be in the moving business and the storage, and not the storage business? How did we end up storing? So that was the question. And so actually there was a profound document that UBS published to the world. We called it the shareholder report, but there was a document, I don't know if you remember this, back in 2008, 2009, SocGen did something similar when the Kerviel incident happened, where they published to the industry and the world saying, this is how we think the subprime losses were allowed to happen. And it's a 50-page document. I still refer to it every once in a while. It's fantastic. About, in my view, I was part of the team that helped build it, but so I'm a little biased. But it was thinking about strategy and risk appetite setting. We talk a lot about that now, but it was sort of not something that a lot of people talk about, even from an audit point of view. So we said, yeah, we ought to do audits of the strategy and risk appetite setting process. And we were one of the first. Second, governance. There's something wrong with governance. And so we were the first audit department on the planet in any industry to start doing audits of the board and government. And tricky, audits of, and then thinking about for the things that we normally audited, front to back processes, market risk, credit risk, transaction processing risk, that's where all those other things about root cause and influencing outcomes came to play. So all those things with the no surprise criteria, those new types of audits that we were doing, this new focus on being more influential, I was so proud that many of those things got adopted initially by the UK in the regulatory expectations of internal auditors. It's now much more embedded in the expectations by the likes of the Fed and the OCC and regulators in Asia as sort of this is what we will expect of every internal audit department on the planet. Yeah, this is cool. We helped write the new book, and I'm very proud of that. And of course, so you're feeling pretty good now of 2010, 2011, markets are getting a little more steady. We're starting to get some street credibility for this, influencing outcomes changes that we were making, setting the new standards for internal audit in the world. And lo and behold, we get kicked in the stomach by Kweku Adeboli.
I'm just going to pause Jim again and quickly explain to listeners who aren't aware who Kweku Adeboli is. He was a rogue trader who was found in 2011 to have been running unauthorized trading positions that ultimately cost the bank $2.4 billion. Given the sums involved in the firm's history, this was a big deal. Adeboli was subsequently convicted and sent to prison. I should also disclose that I was the regulator who dealt with the case in the UK. What he'd been up to came out as I was in the middle of my second week as a regulator, and it very much shaped my career. There's more on his story in the show notes.
That was a major setback. And even for me personally, I thought, holy cow, talk about losing all credibility for having repositioned yourself and now focusing on risks and something like this happened. And I thought for sure that was going to be it. If I managed to survive crawling out of the $50 billion subprime crater with my career intact, this is going to be the end of it. And I called on the internal analysis that I luckily did through the subprime crisis was, how did this happen on my watch? What could I have done differently? What should I have done differently? And for me and my team and my colleagues, and I had that apparently oozing from my pores in such a way that it was building confidence that I would help people figure it out. And not, which is an opposite reaction to what most people, I believe, unfortunately do, was deflect, defend, deny, blame, point. Wasn't me, it was them, And when you start to be the person who says, no, I don't know how this happened on my watch. That's the mood in the room is completely different. Oh, Jim, it's not just you. There's a lot of people to blame, start patting you on the back and feeling bad for you. Like, not that that's what you're looking for, but even that psychology, if you do take that personal responsibility and that ownership, you're more likely to find out the right answer as to what you need to do differently going forward. So we, tuned up the book a little bit and said, okay, these are the lessons we learned from that. Broadly, we're still headed in the right direction, but here's where it didn't happen quite right. And we tweaked again. And so I thought, okay, this is pretty good. Put a little more paint on it, put a little more belts and braces here and there. And the learnings from that, among others, was trying to get front to back control ownership with the first line of defense. And that's something that we still strive for in many places. And then when again, we now are retooling from that, not only in the audit department, but in the bank. And lo and behold, the industry gets affected by LIBOR and foreign exchange manipulation scandals. And again, that was another kick in the stomach. And you begin to think, well, when is stuff like this going to stop happening to our industry? But this one was different, I felt. And this is where your mission now, Christian, is so important, because it was not as much about controls as it was about conduct of people. And as an auditor who's a specialist in putting good control processes in place, we always say it's very difficult to control collusion. And it's very difficult to, like, how can I prevent a trader from picking up a phone and calling someone or meeting someone in a bar and making some kind of untoward arrangement? It's very difficult. And that focus on conduct, culture, so important, and investing in the preventative measures that a company needs to take to have the whole, almost every employee in the company be really aware of what's acceptable behavior or the model behavior and what's not, to feel such ownership for the place and pride in the place that they are very willing to call out a colleague for not doing the right thing, for reporting a colleague, using whistleblowing hotlines, whatever it might be. Instilling that kind of ownership and accountability in every single individual, that is worth its weight in gold relative to a control environment that is there to detect. And as much so, like I'm in bringing it to today's time and beyond the financial industry, defunding the police. Right? I've thought about that a lot in the context of the financial crisis in the industry. So the phrase drives me crazy personally. I don't like it. The people who, and it's all about, and I know you're the nudging that you spend so much time talking about and analyzing and promulgating that. So I thought that firms ought to invest more time and energy on culture and preventative measures. And if you did that well, you likely can spend less over time on enforcement and detection. Now, if the world said, in light of the events that occurred, we ought to spend more time and energy on preventative measures and culture and making sure, people are more compliant in general, and then we can spend less on enforcement and detection. Yeah, that makes sense to me. Defunding the police is so emotive. Like, same outcome. Yeah. And the way you go about it might be different, but it's that idea of having, getting it right up front with people behaving in the right way is the mission. And I want to come back to, if you'll indulge me, just on this cross-industry thing. So somewhere along the journey, I forget what year it was, it all blends together, but somewhere in the middle of that story, I was then the head of internal audit for UBS, and I got invited to participate in this cross-industry meetings of audit heads from all different parts of the world, or all different industries. There's about 25 people in the room, and it was hosted by Shell in London, and it was very nice. And we're sitting right there in the boardroom on the Thames River, and thought this is pretty cool. And it's the first time in my life that I interacted in that way with people who aren't in the financial industry. And I've been in lots of those groups with the financial industry where you're always commiserating about where the regulators killing you here or there, or what issues you're dealing with on emerging risks and cyber. You have those conversations, and there's, it helps distill groupthink a little bit, but you're still in the group. And so when you get to this cross-industry forum, I remember, so our host has to introduce their audit approach, what risks they're worried about, and that's how we get things going. And everybody introduces themselves around the room. So there's 25 or I was the 25th, some of the most impressive leaders that I have come across, and they were the heads of internal audit. And I thought, wow, this is really unbelievable. And as they're introducing themselves, I was the only, I think, if not maybe one other, career internal auditor. Everybody else had run the oil field, had run manufacturing or sales, and they were sort of rotated around. And I thought, oof. So I started feeling smaller and going, oh man, I'm out of my league here. Second, so our host talks about the number one risk that Shell was worried about was death. Safety, workplace safety, and oil spills and people getting hurt. Oh my God! The financial industry, not worried about death. Suicide maybe if somebody, who knows, but. Holy cow, man, I felt so small. So for the next 2 days, we're comparing notes, we're sharing things, and I'm telling people what we were doing in response to learning the lessons of the financial crisis and adjusting the book. and the standards. And so at the end of this 2 days, another one of my really unbelievable moments was the moderator asked everybody to go around the room and share, what's the one or two key takeaways you've had from this last 2 days. And 20 out of the 25 people mentioned something that I'd said. And I thought, wow, as wrong as we've gotten it on so many things in the financial industry, what we were doing collectively to address it, most other industries needed to do as well. And yet they just hadn't suffered in that way. So they didn't have that burning platform to try and, be the impetus to change. And I can only imagine, never waste a good crisis, right? The best thing that I think from the biggest takeaway from Kweku for us was that, it was not big enough of an impact to kill us, but it was big enough to get our attention and all of our stakeholders' attention. Those moments, I can imagine how hard it might be to pivot the change if you're not in the wake of a crisis. I understand that's got to be hard, but people need to try, and because that's going to be the most effective way to stay out of the crisis in the first place, in my view.
There's so many things I want to pick up, but a couple of things occurred to me. I think the first thing I wanted to pick up was kind of the structure of audit functions, because, the way you depicted it is kind of interesting, which is sort of, there is an implicit presumption that that's your job to catch this stuff, right? So if something's gone wrong, why didn't you spot it? That neatly glosses over there were a load of other people that could have spotted it. I mean, you're coming at the event after it's happened. So by default, the proverbial horse has bolted. And it's kind of like, so you might catch it early on, but so there's got to be something sort of, somebody else has failed to do something for you to be able to spot it in the first place. And I do think there's something interesting around the construct of audit and the expectations around it. And I wonder whether, what your thoughts are on that, because we place a lot of faith in that. And whether you talk about internal audit or external audit, there always seems to be this big shock of why didn't the auditors clock this? And they're the kind of go-to scapegoats, which is exactly to your point around, I'm worried I'm going to get fired here because I should have spotted this. But a logic would tell you that it should be people closest to the incident that ought to have responsibility. And hence the audit is referred to as the third line of defense, right? It has slipped through the other two for you to be able to catch it. And so in a way, the construct that we have around audit places a lot of faith in something, and we place a lot of responsibility and emphasis on it, when actually we're looking at the wrong thing, arguably. Absolutely.
And I think going back to that no surprise criteria, and it's not exactly to your point about the structure of the audit department, but one subtle thing that I think most of our auditees never really appreciated, the contours and textures of an audit approach, they probably don't think for an NSA, is in an audit report. One of the things we did was you had to have, what's your objective? What are the key risks you're auditing for? So before the event, you say, okay, these are the top 3 things that could go wrong. Therefore, I'm going to assess the ownership, risk management, and control over those 3 things. And if they're working, as the head of audit, I want my auditors to write their 1-page audit report as to why. Why do they believe they're working? And if you follow me for a second here, most auditors or audit reports write a summary of the issues they found. They're never held accountable for explaining why they didn't find an issue. So it's almost like an adverse scenario. Yeah, I happen to find these 5 things and I'm going to report them. But I was really looking for these other 10 things. I didn't find them. Well, is that because you didn't do a thorough job? Is that because it's, you cut the scope? Is it because you didn't have enough time? Or is it because it actually is well designed, is well managed, is well controlled? And if it is, say it. Because your job is to provide assurance, not provide exceptions. And that's, to your point, a classic case. It's not so much where the third line relative to the other 2, but just the mindset of what is it that we're doing here? And so it surprised people when you bring it to their attention. We would have a whole audit report, executive summary, that never mentioned an issue we found. Even though we found an issue and said management should fix it. And boy, how profound it is on your auditees when they begin. It's a subtle thing that you begin to realize maybe they're not out to get me. They're willing to say when something works. So maybe I'm going to listen to them a little closer when they say it is working. I mean, most of our auditees, if you interview them, they wouldn't say, "Yeah, that's great." They wouldn't think of it. But subtly, we're hoping through osmosis that that's getting across.
It's a really interesting psychological point, right? Because if the auditor coming to see you only has downside, then it becomes a game, and there's an incentive to that game, and it's very clear what that incentive is, which is get your way through this process. The best outcome you can hope for is something neutral with some minor things that you need to correct. So throw them a little bit of red meat. Maybe you almost deliberately concoct something, find something that you haven't quite fixed, hand it over, and there you go. There's your sacrificial lamb.
Right.
And that's the game you play. And I think it's interesting when you talk in those terms, because if you set up the audit construct like there's no way you can win this game, it's only how little you lose by, then guess what people do?
Right. And then to go to your point about the first and second line. So second line, same kind of thing. You have to say, well, if the auditors found it, how did the second line not find it? That's generally, I'm not a, we can come in and discuss the strengths and weaknesses of the three lines of defense model, because I'm not a huge, over time, I'm beginning to question the value of some of the attributes of that. We can come back to that. But if you get to a spirit where you want the first line to be accountable and responsible for the front to back control environment, and not only they acknowledge it, but that they actually live and breathe it, that they demonstrate that they're aware. Another thing we did to reposition the audit approach was to say, in that very spirit, is it's crazy. At the beginning of the financial crisis, I think for every 9 issues that internal audit found, management found 2. It was some kind of ratio like that. And that was very consistent across all my peers in the other firms. Some people didn't even know how, even in the other industries, there was no register for self-identified issues by management. There was no such thing. You didn't even know what the other number to compare it to was. It was just they had audit. So to think about that, I say, well, this is crazy. And so you say, well, auditors are going to find things, but I shouldn't really find that many significant issues, things that we would consider significant, because, in big companies, 2/3 of the people who work there are some sort of controlling role or, supporting role. So if 2/3 of the people are working there, and you have, very senior, seasoned people who are leading there are very risk aware, how could it be that the audit department has to tell the first and second line something significant about their business? How could that be? That should be offensive, like crazy. So if you say, well, yeah, that's true, that shouldn't be. Every once in a while, okay, you want to top up and strengthen and retool, like I mentioned earlier, but by and large, the significant things should be self-identified. So what are the practices that the first line and then challenged by the second line ought to be doing to make sure that they're aware? Well, they ought to know what their front to back controls are. And they ought to have the line of sight as to whether they're working or not. That'd be a good start. And so we said, yeah, that's a good idea. Actually, why don't we reposition the whole audit approach to start with that? Well, we're going to kick off an audit. First, you guys come and present as the first line, whoever the owner is for the control environment. You tell us what you think your front to back control environment is, and you tell us how you know it's working or not. And the better that you do that, the lighter touch our audit will be. Because now we can just test, that whether it's in line with what you described and whether it looks reasonable on paper. Really lightens it up. Or alternatively, they come in, they go, what do you mean controls? And they're drooling on the table. Well, I'm not going to audit that anyway because it's probably a mess. I'm going to issue a note to the senior leaders in the board and saying this group doesn't have a clue.
Right.
So, yeah, we'll come back in 6 months, and hopefully you're less clueless. And when you think about going back to third line assurance, that's what it ought to be. But unfortunately, in many places, the audit departments are reconstructing the control environment, are doing all the kind of assurance work on behalf of the first and second line. I mean, that's improved a lot over the last few years. But it also goes, I used to be so surprised with a lot of focus on assurance maps. Who's providing assurance on what? And this was a lot of discussion about the 3 lines of defense need to get together on, who. I was like, well, I don't understand. Like, as audit, I'm providing assurance on everything. Why do I need a map? Well, there's nothing I'm not providing assurance on. What do you mean? And I couldn't, it was always like I was speaking a different language from other people. I don't understand. But then I met, I won't name the companies, but it was in the food service business where I was surprised to learn that, I said, well, what audits of food safety do you do, Mr. Auditor? Well, we don't. What do you mean? Like, isn't that the number one risk? Oh, yeah, but that's that other department. We focus on financial statement, SOX controls. Wow, that's interesting. So when you go back to no surprises and what's the number one risk facing the firm? Well, food safety's got to be up there. And then what the department doesn't look at? Yeah, they probably need a map. Okay, and now we understand what you're talking about. But I would question, to make sure that someone's providing assurance on the key risks affecting the firm. But why isn't our department doing that? Shocking. And that goes back to this cross-industry, like the financial industry never get away with that right now, but a lot of other industries, maybe they do, maybe they don't. I don't know. So,
but there's something interesting there around when you look at things that are sort of literally matters of life or death. So whether we think of airlines, food safety is a good example, medical profession. Actually, generally speaking, ignoring renegade operatives, but generally speaking in society, we have that kind of sorted. It is pretty safe.
Yes.
Remember those days, getting on a plane, right?
Yes.
It's pretty safe to do. And so the issue airlines have is not around the safety in the skies. It's data breaches it's crap on the ground. And you can say the same actually with a lot of other companies. And so it's fascinating in a way that when I look at those industries that have safety critical things where there is a literal life and death thing in it, they tend to have the basic activity reasonably well under control. I mean, you can always find exceptions, but it's in the other bits that fell down. And it always struck me that financial services, because the consequences of the failure don't have that kind of direct. I mean, there are definitely indirect life and death pieces. I mean, we can see lots of examples of sort of knock-on consequences, but that doesn't sit within the industry. It's certainly not visible to the people there. And so it always sort of struck me that actually financial services, on the one hand, wasn't necessarily desperately good at controlling its core activity in a way that the medical professional, the food safety industry were. But there was a realization around that broader contextual piece around the organization. And so when I look at where do most companies not get things right, it's not in the core bit that's tightly regulated and tightly controlled where there's life death. It's in those peripheral bits, which is probably the bit ironic that financial services actually has always had a handle on.
Yes, absolutely. And I when you're talking, I'm thinking about what you've covered in the past, and we've talked about, you and I, for a long time, is like getting fewer controls, fewer, more meaningful control. Simpler things are easier to comply with than complex things. And that's where the airline industry, their controls are, operating on the wrong leg controls. Remember those studies that I think you've covered in the past where the more controls you added, the more likely is the wrong leg got operated on. And that is something that we needed to learn in the financial industry from those other industries as well. Have fewer, more effective lethal weapons in your controls that are and simpler processes that are easier to comply with, easier to understand, easier to comply with. And I think one of the other things, and go to the periphery, that on airlines going through COVID, I was really taken aback at the beginning when we're talking about stimulus again and support for the airline industry. And there were all those studies about, the buybacks and dividends that were paid out by, which was pretty much all the profits, and they didn't save any money away for bad things that would happen. And I thought, how many times in my lifetime, and you were reasonably close in age, we've seen this multiple times where the airline industry gets shocked by some event. I'm thinking, wow, here's another one where the financial industry could teach them something. That after the financial crisis, capital had to be withheld that withstood severe stress. So if we deem, it's a systemically important industry, financial industry, too big to fail and all those, systemically important, well, we've just concluded so are airlines. So is the health industry. Do they have enough capital in their corporations to withstand so that we don't have to bail them out? So why is these concepts like the capital regimes that we have, or CCAR, or these things, why is that only the financial industry and not every systemically important industry? And I don't think there's an answer to that yet, but there's still arguing about stimulus and things like that and supporting companies. But that's another one where in the periphery, it's not planes crashing, but it is, beyond the day-to-day, front to back controls of keeping planes safe. And that's something that I don't know when I think about, well, who would do that? Where would that happen? It's like converting the banking regulators to sort of almost like enterprise risk regulators, or the Financial Stability Board, is that only about the financial industry, or is it about financial stability of the planet? These are very interesting questions.
We do have mechanisms to protect passengers, right? So there are the equivalent of kind of deposit guarantee protections. If you buy an airline ticket and your carrier goes under, you are protected. So there is a little bit of thinking around what might happen if they're unable to. I presume the logic being you don't want people stranded overseas who can't get back home. So there's a sort of emotional trigger to that piece. And we're protecting the people on Main Street from whatever might happen to them. But you make a very good point around that, which is those broader contexts aren't thought of. And so the risks facing those organizations are considered in the context of traditional risks of those organizations. So what will my regulators care about? What will my shareholders care about? And what my customers care about? And there isn't that societal question, which does apply in the case of banking. So there's an interesting bit, and we can all see why. One is the history, but secondly, the interconnectedness of the banking industry. But you can make the same argument of the airline industry, as you say.
Yeah. So this is a segue into another topic I thought you and I ought to talk about, where we spent most of our time working together closely. So then that evolution of compliance, operational risk, and what that actually means, and a similar thing. Those terms can be quite nebulous. They mean different things to different people. And it suffers a little bit from the same kinds of things that I mentioned in internal audit about, you're fighting the last war, you're fighting the last crisis. Regulation becomes more prescriptive in an area that has suffered. The regulation about the next crisis is a little loose or light. And so that focus by a compliance or an operational risk function as to what can go wrong, their first mindset is, well, what happened last time, and how do we prevent at least that from reoccurring? Well, reoccurring would be really bad, of course. But what do we need to think about in terms of the next one? And what I was also proud of what we had done together with a number of our colleagues, is sort of trying to modernize the approach on compliance and operational risk, and recognizing that they're very similar disciplines, and that the overlap. And I remember that not only for the company that we work together in, but all the companies in the industry, LIBOR was an eye opener, because here you had most stakeholders running around saying, where was compliance? And LIBOR rate setting was not a regulated event. And compliance professionals all over the world says, my job is to make sure that we have policies and procedures for regulation. And better compliance officers would check that they were followed. But, not everybody did. And so here you have a non-regulated topic. So where was compliance? Well, what are you looking at me for? So, well, good point. But everybody said, well, hang on a second. It doesn't feel right for you to exonerate yourself just because there wasn't a regulation. And so, okay, well, we say, most stakeholders would say that if a good compliance officer, somebody threw bubble gum on the ground, that the compliance officer would say, hey, you shouldn't do that. It makes the street messy, you get stuck in your shoe or whatever. Well, yeah, good compliance officer might do that, but any good employee should do that. Make it his job to do it. Right, okay, so maybe you're right, compliance. Maybe we'll let you off the hook this time. Hey, operational risk, where were you? Like, what did you do? Look, me? No, I just don't know a reporting function. I don't really check anything. Hang on a second. So here you have these two units which are growing in size in most institutions, and at the moments that matter, didn't feel any responsibility or ownership and didn't feel like it was their job. It wasn't effective. Man, hang on a second. It's too similar. Putting those things together makes perfect sense to me in any industry. And clarifying what is it that you guys are trying to achieve. And that's where we spent a lot of time with our colleagues that we work with, coming up with that equivalent of that no surprise. What's the guiding light that we ought to have? What are we here for? Either as a compliance or operational second line function on these nebulous risks, these non-financial risks, which I hate that term. Costs more money to the whole industries than the financial risks do, which is amazing. What are we here for? Well, we want to make sure that those risks are understood by the institution. They're owned by somebody. Someone feels that ownership for managing them, and that it's operating within the firm's risk appetite. And I remember when we collectively came up with for me still is brilliant and really hard to do. But if you have a function in your institution who holds that as one of their key responsibilities and make sure the risks are understood, owned, and managed in the firm's risk appetite, that's powerful. Really hard to do. And similarly to auditors becoming effective agents of change, those second line functions becoming repositioning the way they engage. So, do I understand these risks? So, cyber risks and financial crime and conduct related issues, these human risks that we face. Do we really understand them first in that second line function? And if we're not comfortable, what are we going to do about that? Does the company understand them? What kind of training are we offering? What kind of learning opportunities are we offering for them? How are we keeping the pace on the development of that? That's interesting. So okay, we're comfortable that it's understood. Fine, good. Most people put understand in the kind of taxonomy and descriptions and right. No, I mean really, it's in the ethos of everybody's understanding. And then ownership. Don't mean having a spreadsheet with someone's name next to a category. I mean, you look into senior management's eyes and you can tell, like I mentioned in that auditor conversation, that they demonstrate in who's from the report that they own that very risk. And if you're looking in the eyes of their soul, and again, they're drooling on the table, you got a problem. And what are you going to do about that? How are you going to get that person to feel ownership? And if they after a period of time they fail, you got to get rid of the person. And the second line, and I'm refusing to call them a compliance officer or an operational risk officer on purpose, but that risk manager, risk controller, has to have the techniques and the skills and awareness of what to do in that very situation. And that's a whole different ballgame than what most of them are trained to do. And then the third, on setting the firm's risk appetite, that's also fascinating because, and I know a lot of people talk about that, and you have risk appetite statements, and some of them, some companies, and I'm not just talking about the financial industry, have a reasonably good attempt at doing that. But what they're normally describing is sort of a value system, not necessarily a risk appetite. So I go like to cyber. We all know that it's very difficult to eliminate cyber risks. You can't eliminate them completely. It's a matter of when you're attacked, not if. All those things. Well, if you know that, and how much money should you be spending and what kind of controls can you put in place, to say that your risk appetite is zero is ridiculous. You have to have some risk appetite because you have limited your spending. You have not done everything you could possibly do to control it. So how do you articulate how far you want to go in controlling something? For me, that's what a good risk appetite statement looks like, based on everything that I've seen. So, and very powerful, provoked by what we came up with on that criteria of an effective function, is that if you can challenge that we get, go in with cyber or data protection, you could have a situation where you create in your company clean rooms all over the world. Everybody who works there is in a clean room. You turn off all printers. You turn off all internet access. You have cubby holes. If you do go into an office, you have cubby holes in the office where you check your iPad and your iPhone and you pat people up and down to make sure you're not bringing in or taking out anything of the company. You could do that. It would be really hard to run a business. Morale wouldn't be very high, I would imagine. So you say, okay, maybe we don't want to risk our employees on the way in and out of the office every day. Oh, interesting. So you've already expressed a risk appetite. So if you found somebody who stole all the crown jewels of data, put it in their lapel as they walked out of the building, yeah, you kill them. You fire them and you hold them accountable and everything, but you wouldn't beat yourself up over the control environment. And you wouldn't add that incremental control. And all those conversations that we often have across the street, well, we need another sliver of Swiss cheese. No, just accept the fact that no, our controls are operating as designed. You find the evildoer, you deal with them, but you don't beat yourself over it. And that conversation, in the absence of an issue, between the three lines about what's the right risk appetite, how far do you want to go in controlling something? If you can have a meaningful conversation on that, the alignment from that is powerful. The cost effectiveness of the control environment is powerful. And what I find, going back to mindsets, is that in those conversations, the first line typically has a lower risk appetite than the third line. Because the third line has spent so much time arguing and is kind of saying, yeah, this is good enough, This is reasonable enough. That's where we draw the line, because we don't want to be criticized as being over the top or chicken little, and we don't want really bad things to happen because we'll be criticized. But that size of loss, that first line professional would never want that to happen on their watch, because they're the one who's ultimately accountable. So they want to tool it tighter, which is fascinating. If they spend the time thinking about it, they would actually have it tighter. And we just don't spend enough time thinking about that. And what's the real risk?
This is part of the problem with the construct, though, right? Which is sort of, if you have functions, and you can call them what you like, but they're functions there to make sure everything's okay, to kind of keep an eye on stuff, people naturally will outsource it to them. So if I'm an employer, I don't want to have to be thinking about the physical security of my building, for example. So I outsource that. Equally, I don't want to be worrying about whether there's going to be soap in the washrooms. So I outsource that to someone else. And I think the mindset kind of continues. It says, well, you have all these functions with we'll call them whatever you want. They're there to make sure nothing bad happens, right? So that's why we have compliance people that we pay to make sure we don't breach any regulations. Job done, move on. I can do. In the same way, I would argue that I take my motorbike to be serviced at BMW because, yeah, sure, I've given it the once over before I get on it to make sure that I've got a flat tire. Have I done all those things it says I should do in the user manual on a daily basis when I ride? Probably not. If I haven't ridden it for months on end, maybe I will. But generally speaking, I outsource that to BMW. Now, I know in my heart of hearts it's my problem, and I'm going to own it if something goes wrong when I'm riding it. But nonetheless, it feels really comfortable to do that, and that's why I take it to them to service, because I bought, I paid extra for that. But I think people have the same approach within organizations, which is we pay for these functions to exist, and therefore I don't need to think about this stuff because those people can do that. And that's as you say, that's a really uncomfortable thing, because there are other aspects of the business where you wouldn't want them interfering with your other aspects of your business strategy, but yet you're perfectly willing to outsource some things that do have potential huge risk. So I think there's a real challenge with the way these things are set up, the way the control functions present themselves, and the way the business has been allowed to interpret these things, that kind of means it's slightly broken, and we shouldn't, in some cases, be surprised we get the outcomes we do.
Absolutely. And I think you've articulated very well where I have these nibbling concerns about this three lines of defense positioning. It's lots of strengths about it and lots of smart ideas, but particularly with the maturity of the way the world thinks about operational risk now, it really muddies this first and second line issue, or really makes it hard to define second line, because in the way we've thought about it, for the reasons you've outlined, if I'm in the second line, and I was with you spending time trying to challenge the first, you ought to understand your compliance risks first line. And I said, well, that's your job. I'm like, well, yeah, but I don't have a lawyer or a regulator, or you should hire them so that you can help you understand the risk. Why, that doesn't sound cost effective, because we're all in this function. So the concept, well, no, hang on a minute. We need a front-to-back control environment that covers the key risks, whether it's market risk, credit risk, food safety, health, liquidity, compliance, regulatory, whatever. All of you got your key risks. You need the front-to-back controls. You need to make sure that you have checks and balances in those controls, good checks and balances over origination functions or revenue-producing functions, but you also need checks and balances between people and operations and technology. So you have to have a well-designed front-to-back control environment with checks and balances in it. The checks and balances somehow gets confused with second line. No, you're part of the front-to-back control environment. Then you should have an independent function that checks that works. So if we described everything, and I don't want to call it a two lines of defense because I don't want it to make it seem like I'm changing the three lines. You have a front-to-back control environment with subject matter experts who know what they're doing, operating their controls with the right checks and balances. You don't get into this conversation as to whether the front office needs a compliance guy or not. And then you have a function where a lot of what the second line used to do, some of what the second line would do is assurance, which was overlapping with what the third line did too. And you stop that Cold War from happening as well. You just have a function that checks and provides assurance to the board and senior management. Beautiful. Simple. And you really clarify ownership and accountability. You would recognize that, and this is where I go back, second line of defense owns risks itself, operational risks primarily, regulatory risks for the processes that it runs. So how do you explain that? You can get your tongue tied and you get a headache thinking about whether you're first or second line in that instance. Well, on Monday, when I'm thinking about this, I'm first line. And Tuesday, when I'm thinking about this, I'm second line. And by the way, sometimes I'm going to test this thing. I'll be third line. Like, forget it. We're confusing ourselves too much. Just simplify. And simpler processes are easier to follow. Anytime we introduce gray or confusion, then that's where one of my great board members, David Sidwell, who you and I both know, he used to always say to me, and challenging us, he said, things break at the seams. And so if you can get rid of as many seams as possible, absolutely, that's where things happen. And that's similar. When you create too many functions, too many different people, it's crazy.
And I think it's this classic thing, and I think it's a great note to sort of close stuff out. And is this idea about perfect structures look good on paper, and then you introduce human beings,
right?
And the bit I find amazing is, we know this intuitively. So we have all, and I was looking the other day, I bought a new chair. And I looked at this, and there was something about do not use this as a ladder type sign, right? And you kind of think, well, who would do that? And you kind of go, I would, right? If I need to stand up, reach higher, I'm going to grab the nearest thing that comes to mind. So to a certain extent, they've kind of recognized the risk. They've tried to mitigate it with a silly little thing on there, which is not going to stop me the best times. But I thought it was a lovely illustration of what we do within organizations, which is we build these constructs. We kind of occasionally have a nod towards maybe people won't totally behave the way we want them to. So we'll kind of try and constrain it. But actually, if we started from that premise of how are people likely to behave, and we designed around that, and as you say, seams and gaps and handovers and cross lines of responsibility and pointing fingers and all those things, allows human beings to do what they're really good at, which is kind of manipulating situations.
Yes. And I think going back to an earlier key attribute of my learnings or what I value in people is people who take personal responsibility and feel like they own something. And the more that is, the more likely it is they're going to overlap on the seams. The seams aren't going to be just touching. They're going to overlap. They're going to go a little bit beyond, and that strengthens everything. And culturally, if you can foster where everybody feels like an owner of what they're doing and feels pride and responsibility, man, that strengthens things a lot. And that's hard to do, especially when something bad happens. Everybody runs for the hills. But where you blame, if you blame cultures and things like that, that's a problem. And I think there's not just, you can see this in so many different facets of the world, in government and in the regulatory community and in various industries. The willingness to take personal responsibility is adding human risk, or either adding or subtracting human risk. So I think spending more time on that and fostering that kind of culture is worth its weight in gold.
Amazing. Listen, thank you. That was a fascinating. I learned some things.
Oh, really?
Yeah. There's always little insights and nuggets and ways of looking at things. And I'm sure my listeners will have done. So thank you so much for, one, the explanation and stuff, and secondly, for coming on the podcast.
Absolutely. Thank you for having me. I'm an avid listener. Love what you're doing. Love the mission. And definitely, anytime you want my help, I'm here for you, Christian. Thanks very much.
So that's it for another episode of the Human Risk Podcast. My massive thanks to Jim for appearing and to you for listening. To find out more about Jim and his work, visit the show notes where I've provided a link to his website. You can also read more about some of the financial services industry stories that we featured in the episode. If this is your first time listening to the Human Risk Podcast, welcome. You can subscribe wherever you get your quality audio content. It's available on all of the platforms. I'll be back very soon with another episode of the Human Risk Podcast. But in the meantime, stay safe and thanks for listening.